2024 is upon us. Now is the time to make decisions for 2023's crop and protect this spring's investment. Let Advanced Trading help you create a marketing strategy to protect your investment and reduce market risk. For over 40 years, Advanced Trading's non-predictive approach has helped farmers secure and extend profits, regardless of market volatility. Our team is ready to help you tackle 2024's uncertainties. You never stop working, and neither do we.
Good morning. My name is Drew Moore from Advanced Trading. I've got Michael Reginelli and Brian Basting in the studio with us today. It's been a second since the three of us have been in the studio. So glad to have you guys in with us to review the USDA December WASDE report. As it stands right now, March corn is down 2 cents, Jam beans down 4 cents, and March wheat, Chicago wheat, down 12 cents, even in the face of some decent strength in the crude market today. But let's focus on the USDA report. Brian, what did the USDA tell us today?
On the bean market, a couple things might have flown under the radar as such, Drew. They increased last year's Brazilian crop. The crop was harvested back in March, April, that time period, 2 million tons. So that gave them a bit more cushion and helps explain how they've been so aggressive exporting beans this fall.
Sure.
So that gave them a bit more cushion. However, they did reduce the new crop, the crop that's growing now, by 2 million tons. So it's kind of a wash. But what USDA did here, Drew, was they increased Brazilian exports for the new crop year, the crop that's growing right now, by that 2 million tons.
Okay.
So, at face value, more competition than expected by the market. That 161 number, though, for production for this year, Drew, is not carved in stone. We're making or breaking that bean crop right now in the north, and we'll do so in January in the south of Brazil the next 45 days. So that number is still fluid, but maybe took a little bit of the edge off of the concerns about weather right now.
Sure. Makes sense. Thank you, Brian. Michael, question to you. What about the grain side of the ledger, corn and wheat? What did you see there?
Yeah, they took corn carryout down 25 million, I believe. That was quite a bit lower than the average trade guess. I think the market was looking for maybe a 3 to 4 million bushel drop. Decent little swipe in the corn balance sheet, but at the same time, we're still at a 2.1 plus billion bushel carryout. It's quite a bit higher than we've been contending with the past 3 years by 6, 7, 800 million over the past 3-year cycle. So if you want to look at, why futures seem to be quite a bit less than the past 3 years, it's a real simple answer that lies right there. So that's one of the main things, but that was a little bit of a friendly surprise, I guess, to the market. Corn futures have also rallied, 20 plus cents here, over the past 10 days or so.
Right.
So probably not seeing a huge reaction even with the modest reduction in carryout. So the one thing on the corn side too, though, is the Brazil corn number was flat at 129. That's interesting compared to where some of the private estimates have come in. Conab's at, I think, 118 and a half. So still a bit of a variance there on what the expectations are for Brazilian corn going forward. And we'll have to certainly keep an eye on that, especially with some of the delays in the planting of the safrinha crop as we kind of move forward here.
Sure.
But the wheat side of the ledger as well, if we're on the grain side, wheat carryout also dropped by 25 million. That was all soft red, basically, if you look at it from a class by class. It makes sense given the recent round of flashes. We had another flash on soft red wheat this morning. It's been a pretty consistent trend here recently compared to the early part of the marketing year where we had no export demand for soft red wheat. So the market's changed quite a bit there, but that's the reason that we did see the U.S. wheat carryout tighten up a little bit.
Sure. Nope, that makes sense. So all that being said, and taking into consideration what Brian had noted and what the USDA has come out with, what are you seeing in terms of cash market and spread structure standpoint?
Yeah, I guess on the wheat side, since we just talked about that, the wheat basis market is focusing on soft red because that's where we saw the drop today, has firmed considerably over the past several weeks. Some of it is, a lot of it's related to the export demand that's been conducted. We've seen higher SIF numbers. We've seen higher interior basis via rail moving to exports. That's forced some of the mills to increase their basis to get somewhat competitive with that. But there's been certainly a basis run here in the past few weeks in the wheat market, which would be in tandem with this jump in exports and the tighter carryout, tighter stocks on the wheat side. Spreads have reacted accordingly. Wheat spreads have narrowed fairly aggressively. If you look at the March-July wheat spread here, just 9-10 days ago. It was trading over 30 cents carry, and here we are today, in 20 cents from those levels. So cash goes up, spreads narrow. That's, typically how the market works, is those two things work in tandem.
Right.
On the beans and the corn side, we're seeing a little bit of strength in certain markets. Some of that's likely just post-harvest strength. Bushels are either getting put away on the farm, they're put away in hard storage. Harvest is really slowing down. There still is some harvest going on in the east. There's still some corn, flowing, that's standing in the field. But for the most part, harvest is behind us. If demand needs covered through the holiday season, you're seeing a little bit of an uptick there. It's also not anybody's favorite time to go move a bunch of freight from a logistics and a transportation side, especially once it gets put away. So seeing basis pops in certain markets. The export market on beans is certainly feels like it's firmed up a little bit this week as well. Spreads have narrowed a touch on beans, but there's still a lot that we have to kind of learn as far as corn and beans go as we shape spreads and work our way into the first part of 2024.
Sure. Thank you very much. Brian, Michael's touched on some of the wheat dynamics and the tandems of the market with spreads, narrowing, flat price rallying. So what are some of the dynamics that have led to some of these flat price rallies in wheat, and will it persist based off of what you know today?
The biggest driver in the wheat market by far, Drew, has been China. They've come in here and bought, just this week alone, over 1.1 million tons, as Michael highlighted, soft red winter wheat. USDA bumped up the soft red exports 30 million bushels today, 175. We're not necessarily looking at the demand across all classes. It is strictly isolated, as Michael highlighted, on SRW. And China had some issues with quality this past summer. So they're Chinese have been known to be excellent traders in the market, and they have come in here with wheat at a multi-year low, Drew, and they bought the market. So whether or not that'll hold longer term, we'll have to wait and see. But I'd remind the viewers that we're also looking at less acreage planted this fall across the eastern corn belt. As Michael knows, Ohio, Indiana, stretched that up into Michigan and even in Ontario. From reports, Drew, that we're going to see a drop in acreage. So just something to keep in mind, as Michael highlighted, the narrowing of the spreads, particularly in wheat, is something that Michael would be able to advise folks on, because it's a dynamic that's changing, Drew. But overall, though, I'd say that if you want to get into a bit of risk management for 2024, I think at this point we'd be looking at soybeans, Drew. We're looking at a soybean price for November at $12.80, $12.85 a bushel. That is well above production costs for producers across the country, Drew. I would encourage producers strongly to consider getting some risk management positions in place with a trusted risk management advisor. Give yourself some flexibility. There are a number of different marketing tools a producer can use, Drew, but get some floors underneath this market, because we don't know what this Brazilian weather or Argentina weather is going to be. I would remind the viewers on one thing about Argentina, Drew. USDA is forecasting Argentina soybean production to nearly double this year. Another 25. Let that sink in a little bit. So even if the Brazilian crop does come down, Argentina had that terrible drought last year, and they're off to a good start right now, moisture-wise. So long way to go, but what market is offering a good price today, recalling that insurance price, Drew, won't be set until the end of February. So corn, I'd also encourage viewers to look at that 2024 corn pricing decision, get some floors in place. There's some areas where it's a little closer in terms of closer to production costs at 510, 515 East corn, but still nice to get those floors in place for next year's production for both corn and beans.
Especially with expectations for higher bean acres here this spring. Obviously the corn bean dynamic changed from a price standpoint between now and then, but most are expecting at least a couple million more acres of soybeans for next year too. So if we get stable production in South America, it could change the dynamics.
Absolutely. Thank you guys. Very, very good good reviews there. Michael, last question for you. From a end of year money flow standpoint, we've seen a nice pop here last month and beginning of this month in equities, and also crypto and certain commodities, not necessarily energies. But when we look to grains and we look at seasonality, what are your thoughts in terms of funds covering up some of these shorts, persisting into the end of the year?
So it's interesting. You have a different dynamic playing out between the oilseed complex and the grain complex. So we're the bean market has dropped 70 to 80 cents here recently. Funds were running a pretty hefty long position. I think the average estimates are probably down 15 to 20,000 from the last commitment of traders numbers, which makes sense when you see the drop. Now the last 2 days, we've probably chewed into that a little bit, but it's somewhat similar to last year. The big change is the corn and wheat markets. So corn, I think we've popped corn a little bit here, 20-some cents. That's probably not as short as the last commitment of traders, where we were over 200,000 contracts net short for the non-commercial or the spec fund.
Right.
Probably closer to 174, 175 today. But the difference is they were long this time last year. They weren't short. They're running a heavy short position. This time they were net long last year, which is a totally different dynamic. But it also speaks to what we started with on bigger carryout numbers, more burdensome supply, less demand, however we want to chew it up to get to the heavier carryout. But it's a pretty bearish stance from a corn standpoint. Wheat's kind of the same thing. Now, again, on this rally that Brian and I kind of noted, mostly driven by exports and anticipation of potentially more exports. They were short about 120,000, I think, last Friday on the commitment of traders. Today is probably closer to 80-ish.
Sure.
So they've chewed into it a little bit, but that said, they're still running a pretty hefty short wheat position. If we continue to see rounds of business to China, though, and we really turn the screws and tighten up that soft red wheat balance sheet more, that stands out to me, though, because even though they've cut into that quite a bit, if they're still 70 to 80,000 net short, there's still more room for short covering if this market wants to rally. So it's something that we have to be paying attention to.
Absolutely.
It is a different landscape, though, than we've seen the past few years.
It has. Yeah.
I want to add on one thing to what Michael said there a moment ago, Drew. He did a terrific job talking about the change in the corn environment from a carryout that was relatively tight the last few years at 1.2, 1.3 billion bushel.
Sure.
Michael did a terrific job. You're talking about an 800 million bushel increase compared to the carryout of the last few years at a 2.1 billion bushel carryout. What I'd remind the viewers of is we have a carry environment now in corn.
Right.
Managing a carry environment in corn from a producer standpoint is much different than the last few years when there was very little or no carry in the corn market.
Or inverses.
So, exactly. So I'd strongly encourage a viewer who's not accustomed to managing, and that's a key word, managing a carry in the old crop corn market, Drew, to work with a trusted risk management consultant on that, because that carry can melt away over time almost imperceptibly, where you don't realize that the market is grinding lower, for lack of a better phrase.
Right.
One possibility.
Right.
Obviously,
Yeah.
a lot can happen, but obviously, along with our 24 sales, managing those 23 bushels.
Yeah,
Right.
well
Yeah.
said.
It's a different market than we've been accustomed to the last few years. Thank you both for your time today, and thank you viewers at home. It's been a good 2023. We're looking at some different items next year in terms of reporting, and maybe having a quick snapshot even closer to the 11 a.m. report release with our friends and colleagues at ATI Pro Media, which will be coming in the second week of 2024. So we're very excited about that. Feel free to like and subscribe to our YouTube channel as always, and Merry Christmas and have a very prosperous New Year. Thank you.